I'll start the recording now. I'll edit it later. So welcome to this is our first training on bonds. So we'll be doing a couple of these soon also. We hope the aim is basically at Mwango Capital. We just want to make sure that people understand investing and investing basics so that they can put their money away every so often. So I met George, I think a couple of weeks or months ago on Twitter, and then we started engaging on bonds. He's like my go-to guy on bonds. I have studied bonds, but I have not really been keen on that. So I'm also here to learn today. And generally because the bond market is one of the most crucial parts, I think, of government in Kenya, especially because the government plays a very key role there. So I think we're going to learn a lot. Make it interactive. Ask him as many questions as possible. He has prepared a lot. He deals with bonds every so often. So I think the latest one he's dealt with is a Family Bank bond this past week. So he's going to tell us how you get started and all these things and share with us as many links as possible. So looking forward to learning also. So George, you can take it away. I'm in the background. I'll be in the background a little bit. So if you need anything, just let me know. I'll be monitoring also the chats.
Okay, no problem. I hope I'm clear.
Yeah, I think you are.
Very, I am. Okay. Thanks, Eric. And as you rightly put it, true, we met a few months ago, and we got to know each other. Things have picked up. We've exchanged ideas, and it's been a good past couple of months. So I'm really happy to have met the team at Mwango Capital, and getting to work with you is also a very good thing. At least we'll be able to bring progress in some areas of the capital markets and in whatever sphere that we want to improve on as individuals or even as corporate clients, whichever way.
So the question I would start with is, you tell us a little bit about yourself and what you do.
I was going to that.
Yes.
So basically, my background, I did actuarial science. I have a degree in actuarial science from JKUAT. Then after that, I started working a bit. I worked for a company called Quadrix Capital. They were actually one of the first. The person who founded it was one of the first people who did bonds in the Kenyan market. They're the ones who came up with the first corporate bond calculators, So he's been around, the person who founded, the CEO of that Quadrix Capital then. So I worked there for like 3 or 4 years. And that's where, actually when I started, I was doing equities. Interestingly, then I moved to bonds now, and that time the market was very, we'll say, small. There are days, I think I talked about this, the days we went without doing a trade the whole month. Actually, there are times there were 0 trades. So basically that time I was just doing settlement, the back office work bit of it, following up trades and seeing that they've settled. I actually did very few trades myself. So I took a break around 2011, 2012 there to do a diploma at the Chartered Institute of Securities and Investment. I did a diploma in investment operations. So now I think I became better now in the settlement and in the ops bit of both actually equities and bonds. Then in 2014, I was approached by some fellow who was setting up an agency, which actually was also doing the same thing, bonds and equities. So he wanted a bonds trader. So that's Daffodil Securities. So that's where I moved. That's where I've actually been working. So Daffodil does the same thing. It trades on the market. It does equities. It does bonds. So you have, for bonds now, you have a select group of clients who you trade for. and also now the market in general. Yeah, so basically that's my background.
Yes, now you can get started on the training then. Maybe you can tell us basics of bonds. I think you could hold on like the 3 minutes. I think there was someone else who got Google's Meet instead of Zoom.
Oh yeah, there were 2 invitations.
Sadly, yes. So just a minute, they're switching. So I just sent them an invite. Bonnie is here. Just Nathan. Just a second. Just give me 3 minutes, okay?
Okay.
Okay. What bonds have you been trading this week? If you can maybe in the meantime, let us know about that. How you're muted, by the way. You're muted.
Yeah. This week, I'm just focusing on the tap sale. So there are some few clients who wanted the tap, and I think we got it. So
What's a tap sale, by the way?
We'll get to that.
Okay. You need to explain that because you see that a lot. I think we need to have like all the basics right at the end of it.
Yeah. Today you'll have everything.
All right. All right. I'm just waiting for Nathan to log in. Let me call him. Just a second.
Okay.
Thank you. Let's go.
So we can continue?
Yes, we can get started. Yes.
Okay. So there's a small. So basically today we'll look at, we'll start from the beginning when it comes to bonds, everything from how to open your account, how to pick whichever bond you want to buy, how to pick the specific bond, how to pay for it, and then when it's in your portfolio, how you can trade it. You know, I came to realize, and this happens quite a lot. So people will be quick to probably open their CDS accounts, those who have opened an account, and after that, they don't know the next process. Somebody will hold the paper, like last week I was dealing with a client, they've held the paper for I think 2-3 years, because it was bought in 2018. So yeah, around 3 years. They don't know the next process of selling. They don't follow the rates. They don't know how the market is operating. So you'd probably rush to open the account, but if you don't look up at the rates, which we'll talk about, if you don't know how the market is performing, then so many opportunities will go by. We'll explain that as we continue. So I have a small presentation here. I hope everyone can see that.
I can see it.
You can see it?
Yeah.
Yeah. So
I was going to discuss about bonds.
You can many about it. Basically, this is the content, and I think it will cover everything that we're going to talk about. So the introduction and classification of bonds, features, properties of bonds, how to invest, how to trade in bonds, the risk of investing in bonds, and emerging issues in the bond market. So when it comes to introduction and classification of fixed income. First of all, what is fixed income? People call it bonds. It's the same name. It's the same thing. Fixed income and bonds, they're actually the same thing. They give you a promised cash flow. When you look at equities, the shares that people buy, you realize you can never tell where you'll get when you'll get a certain payment. You don't know. You don't know if you'll ever get a dividend. There are companies which don't pay dividend. There are companies which you'll buy and the share price won't appreciate. Probably it will be flat for a couple of years or it will decline. For equities, you can never tell how. There's so many variables. But now when it comes to fixed income, you can tell with certainty that I will get X amount of money in this period. So, you know, you've invested maybe 100,000, you know, 6 months from now, you'll get a certain payment, a small coupon or interest payment, and another 6 months, you'll get a further payment down the line. So fixed income, there's the promise of cash flow. There's a promise that you will get your money that has been agreed beforehand before you invest. So we look at basically the two different sets of fixed income. Let's just use that word. We have the government securities and corporate securities. So as the name suggests, government securities are floated by the government, and these are various governments from all over the world. So like in Kenya, we have a Kenyan government which issues its own securities. So we have the treasury bills and the treasury bonds, and we look at the difference between the two. Then another line item, another branch of fixed income securities, we can go to corporate securities. Here we have the commercial paper, and commercial papers are usually very short term, probably not more than 270 days, and they can be known as unsecured promissory notes. They're just a company wants to borrow for a very short term to plug a deficit. You'll agree on the rate. You as the lender will give the company money, and at the end of that period, they will return your money. For example, in our local scene, a while back, Nakumat, which is not there anymore, had issued a commercial paper, and I remember guys complaining about the rate. I think it was around 25%. So they had issues with liquidity, so they wanted money. So they issued a commercial paper, but they never got to pay it back because they collapsed. So commercial papers are for corporate entities, and then medium-term notes. Medium-term notes are debt notes. Same thing. A company borrows from you, and then mid-term is usually between 5 to 10 years. We've seen the last one for Family Bank. I think it's 5.5 years. So they borrow from you. They use that money that you've lent them for various activities within the company, and then they pay you back with an agreed rate. So maybe you'll agree 12%. You'll give them money, and there'll be a structure on how the payment will be made. That is the same as corporate bonds also. A corporate entity comes into the market and wants to borrow. But now these can be very long term, can be now 10, 20, 30 years. It depends. It's not limited to mid-term or short durations. So companies borrow to plug in their deficit and use the money for various activities within the company. Today we'll be focusing more on the government side because I think that's where most of the activity is. We'll talk about the corporate bond sector in Kenya, but we look more into the government side and see how it works, because when it comes to volumes, government bonds do quite a bit of volume in our market as compared to the corporate bonds. The corporate bonds are just picking up. We had a few a while back, but over the years, the market has really died. It has really gone down, but now it's picking up. So we'll basically concentrate more on the government side, look at the various options we have, and then now see how we can take advantage of that. So when it comes to the government, we usually see our budgets every year. We have a deficit. So how do we get money to do a few things that are needed, maybe for education, for infrastructure, for healthcare? We have to borrow. So it's either we borrow from the domestic market or from the international market. And also at times we get grants from different governments to plug in the deficit. So when it comes to local domestic borrowing, we have our treasury bonds and our treasury bills. So I think the titles, okay. We'll start with the treasury bills. They're usually short-term debt securities, and we have three, the 91-day T-bill, the 182, and the 364-day T-bill. When you look at T-bills, they have a difference because they're issued at a discount. And I think before we discuss that, we need to know the difference between a security being issued at par, at a discount, and at a premium. So when we talk about par, which we'll also see on the next slide, it means that the security is issued at a face value. Okay, I'm looking for an easier word. Let's say the face value is 100 shillings. So when it's at par, you will pay 100 shillings for every batch of that security. That won't change. Let's say you want 100,000 shillings of a T-bill. So if it's issued at par, it means you will pay 100,000 shillings, not anything above or less that figure. You will pay 100,000 shillings. But when it's issued at a discount, you will pay less to face value. So for example, the face value is 100,000 shillings. When it's issued at a discount, and let's say you'll be told you're paying maybe 98 for every 100. So you will pay 98,000 for a security that is worth 100,000 shillings. And then the premium is the opposite of issued at a discount. So you will pay more. For example, you'll pay 102 for every 100. So if it's 100,000, you'll pay 102,000 for every 100,000 face value of that security. So when you're talking about T-bills, let's look at like the 91-day T-bill. Let's say the rate is 7%. When you invest in the T-bill, you will pay less. You will pay a discount to the face value. So that means when you're paying, and we'll get to the process of paying and opening the accounts later, but this was just an introduction. So you will pay maybe 97,000, and at the end of 91 days, you will be given back your 100,000. Now, when you look at bonds, totally opposite. Your interest is paid in the future. You're not paid advance. So let's say you buy a bond today for 100,000 shillings, and it has an interest rate of 12%. And let's say there's no tax on it. Our bonds pay half yearly interest rates. So it means during the first half of the year, if it's a 12%, you'll be paid 6% of that value during the first half, and you will be paid another 6% during the second half. So if you've invested 100,000 shillings, you'll be paid 6,000 for the first 6 months and another 6,000 for the next 6 months. So that is the difference between T-bills and T-bonds. For treasury bills, you pay less, but you get more when maturity comes, either if it's the 91-day, 182, or the 364-day T-bill. But for bonds, you invest and you'll be paid in the future. You won't be paid in advance. So,
a quick question there. Who issues these two? Like, who does the issuance of bonds and bills? Like, specifically, the government is issuing, but they're doing it through someone else, right?
Yes, that is correct. So the government will come up with figures they want, but the issuing entity, in our case, the custodian of the bonds and the T-bills is the central bank. So the central bank of Kenya is the one that will say that, okay, the government wants 60 billion. They will come up with the details that if it's a bond, they'll come up with the details of the features of the bond, and we'll come back to that. I'll explain how they decide and how they pick which bond they'll place at a particular time. But you're correct. Yes, the central bank now will be told, okay, we need 60 billion this month, and maybe another 25 billion from treasury bills. So, sorry, let me go back a bit. A few years back, when we're talking about T-bills, we used to have, because we have 4 weeks in a month. So a few years back, we used to have the 91-day T-bill in the first week, and then in the second and third week, we have the 182, and in the last week of the month, we have the 364-day T-bill. This has changed, and it changed, I think, like 1 or 2 years back. Nowadays, we have all the 3 T-bills being issued at the same time. So you'll get the prospectus, and we'll also discuss that going forward, which shows that, okay, this week, we're raising 24 billion, and we will do a 91-day, 182, and 364. Before that, we used to have different weeks for all the T-bills, but now they have compressed it, and we're doing all the T-bills in the same period. And the reason to this was there used to be a price differential. They used to be different rates. You'd get maybe the 91-day T-bill is trading at the same, almost at the same level as the 364-day T-bill, but that has changed now. At least now we are seeing clarity when it comes to rates, and we'll also discuss that. So going back to where we were, so basically that's the difference between the two. So for treasury bills, it's on a discount basis. But for treasury bonds, you pay, you wait for the first 6 months, you get your money, you wait for another 6 months, you get your money, and now depending on the length of the bond. So we'll discuss. Now we'll look at the specific bonds now and the features and properties of bonds. The first feature is what we talked about, which is the face value. So in the case of Kenya, it depends when it comes to different countries. In our case, the face value is usually 100, and that is why you'll get a quote maybe is 98 over every 100 shillings. So you'll pay 98 for every 100 shillings. You'll get another quote 101, 102, 112, and we'll also look at the price list and see how that comes in. So basically, that's the face value. Our face value is 100. So when it's out par, it's 100 for 100. When it's at a discount, you get maybe it's 98 out of 100, and when it's at a premium, maybe 110 out of 100. The second feature that we'll talk about is maturity, which is the same as tenor. Maturity is the length of any fixed income instrument, and basically any financial instrument. So you'll get, when it comes to bonds, you'll get a bond which is 2 years, you'll get another bond which is 5 years, you'll get another bond which is 10, 15, 20, and the longest one, which is 30 years. So when you see tenor and maturity, it's the same thing. It describes the length of the bond. And then currency denomination, it can either be Kenyan shillings. When you talk about our local bonds, it will be Kenyan shillings. When you talk about Euro bonds, it will be US dollars. You get other bonds issued in other currencies. Issuer, as Eric brought it up, the issuer is the person who's floating the security. So in the case of our treasury bonds, the issuer now is actually the issuer is the government of Kenya, but then the agent now, the person who's doing the prospectus and doing everything is the central bank. When you talk about the coupon rate is the rate that you get for a particular instrument, for a particular bond, for a particular T-bill. So you'll probably get, when you look at the prospectus, you'll see that maybe a bond has a coupon rate of 12%. And we need to keep in mind that in our local environment in Kenya, this is paid semi-annually. So the coupon rate is 12%, but then it's paid on a semi-annual basis. On this, we also need to...
And George,
yes.
Just before you continue,
yeah,
can we refer to coupon rate as yield?
I was actually going to that. No, it's not the same thing. When you talk about yield, remember the coupon rate remains fixed. That doesn't change during the term of the instrument. So if it's 10 years and the coupon rate is 12%, that is what you'll be getting over the 10-year period, and that won't change. The yield, on the other hand, and I think it should, I'll include it here before sending out the slides. The yield is what the bond is trading at a particular time in point, and the yield changes depending on interest rate. Because you see, interest rates are not fixed. They change over time depending on, there's so many reasons why they change. You'll get probably there's excess liquidity, so the yields will change. When there's excess liquidity in the market, you can imagine a lot of money chasing very few options, right? So yields will drop. They won't go higher because everybody wants this particular item, and when there's a lot of demand, the yields will drop. So the yield is not the same as the coupon rate. When you see when you talk about the yield, it is what the bond is trading at. We'll use the example of a bond. The bond is trading at the secondary market. So the yield is different when compared to the coupon rate, and we need to break this down a little further.
So yield is bond price.
Yes, it's the bond price. We can simplify it that way. Yes, it's the bond price, because using the yield, you can calculate what is the particular price of a bond at any time. So I wanted to explain that when it comes to bonds, when the yield rises, so we'll need to have an example of this. Let's say a bond has a coupon of 12%. So a coupon of 12%, but it is trading at 13.3%, which is the yield, or 13.5%. The coupon is lower than the yield, meaning you will pay less for every 100. If the, let's say now it's 13.5, if the rate continues dropping, 13, that value that you'll pay the bond continues dropping. At 12%, you'll probably pay, depending on how much time it is to the coupon payment, you'll probably pay a price close to par, close to the 100 for every 100. So this is actually one of the most important things that we need to realize. The coupon is fixed, but the yield keeps on changing. So you get people confuse the two. Somebody will confuse the yield and the coupon rate. Those are two different things. So when somebody quotes, like this is a 12% bond, but its yield is 13.5, you will use the 13.5 to price the bond. Later on, we'll also come to that, and we'll see how to use it when it comes down to the bond calculator, and how to understand the difference now between coupon rates and yield, and the impact of yield. As in, if you get a higher yield, you'll be paying less for the bond, and it's to your advantage when it comes to now negotiating whatever bond that you want to buy, and also buying in the primary auction. So I think we'll discuss that probably later on when we look at the pricing and other aspects of the bond. So up to that point, is there any question?
Samuel, do you want to ask your question on yield?
Oh, hi, George. Yes, but I think you've said that you'll tackle it a bit later. I just wanted to know, I mean, if you've already invested in, let's say, a full year bond and it's 12% and the yield rate is 14%, how can you take advantage of it?
We'll come to that. We'll come to that because we look at how the calculator works. And now I think it will be clearer as to how you can make money out of the changes in yield going forward.
Okay.
Yeah, we'll get to that.
Okay.
Okay. Yeah. Any other question?
A question on yield. Does yield affect the maturity of the bond? I mean, does maturity of the bond affect yield?
Yes, the maturity of the bond affects yield. There's look into that. Just 1 second. Yeah. I'll try and break it down simply, as simple as possible. When you look at longer term bonds, and we'll also, I'll note it down, we'll go back and look at it when it comes to the calculator. Let me give you an example. Let's look at the 30-year. It's a 30-year bond, which was issued in 2011. That's the longest bond that we have. The longer the bond, the more sensitive it is to changes in yield. So when you price the 30-year bond, and we look at it in the calculator, when it moves maybe from, let's say, it's currently trading at around 13.40%. When it moves from 13.40 to, let's say, 13%, and you look at how much you're making on this particular paper, and you compare the difference, which is that 0.40%, when you take a 2-year paper and you also price the same difference, you will be getting more from the longer ended bond. So technically, longer dated bonds are more sensitive when it comes to yield changes. a small change in yield brings a very big variation when it comes to the consideration. And that is why the specific people, parties, clients who prefer longer dated bonds when it comes to trading. Because when you get the bond at a good price and you trade it even like just 50 basis points, you get more money out of it as compared to buying a 2 or 5 year bond and trading it at, on the same levels. So to answer you, yes, the longer the maturity, the more a bond is sensitive to changes of yield. Yes.
Maybe I can add a little, like some of the rates you're quoting of 13% are actually more for markets like Kenya. In the US, the treasury bills and bonds are trading at around 1 to 2%.
Yeah.
So the difference, maybe, I don't know if you can explain it, but it's usually that different markets have different rates. So it's good to understand. It could be something to do with also central banks govern these rates a lot. They kind of give a little bit of indication. But as you said, like long-term rates have lower sensitivity, short-term rates very highly sensitive, as you say.
Yeah, you're very true. We're actually enjoying some very good rates, and as you put it, yeah, when you go to Europe or the US, you get a bond which is longer ended, trading at 2 or 3%. We are doing 13, 14% at times. Other African countries, Zambia, 17, 18, even up to 20%. So different countries enjoy different rates. And when now it comes to investing, these rates will determine how much you get, because you get in a specific country, even in the States, if you tell someone you give them probably 4%, 5% per annum, to them it's a big thing, right? But in Kenya, if you tell someone you're giving them 4%, 5% per annum, nobody will want to put your money with you. And I think also later on we'll get into that when it comes to the risks of investing in bonds, and also we look at different rates. Any other questions before we go to the next part? So I think we can move. So before we go to understanding, like, to the concept of trading and how it works, we need to understand that before we do anything, we all, if you're doing, first of all, if you're doing any investment with the government, when it comes to T-bills and bonds, you need to have a CDS account. I don't know how many of us have one. I think for the people who are here, I think I know one. So basically what happens is you need to have a CDS account at CBK, but for corporate bonds, it's just your normal CDS account. I usually get this question quite a lot. Is there a difference between the two CDS accounts? If I have a CDS for equities, is it the same as having a CDS for government securities? And the answer is no, because the custodian for government securities is the central bank. And for you to either buy a T-bill or a bond, you will have to open a CDS account. So the basic process is you visit CBK, there's counter 18 and 19. When you just enter on your left, you pick something called a mandate card. So, and you'll be given instructions. They'll give you instructions on how to fill. Let me share. I think I have a sample. Mandate card. 1 second. Is that visible?
Yes, it is. And I think it's, if you want, some of you can also do this after. And if you have any problems in terms of filling the forms, you can also contact us, and then we can try to get you registered.
Yeah, so basically that's the sample mandate card. So you feel either if it's a single or joint account, this is blank, so your surname. The most important part of this is, remember it has to be in capital letters. The most important part is here where your bank is supposed to sign. So you'll go to your bank, and remember this is where you want your coupon payments to go. And the bank account that you put is where all interactions will happen with central bank. So if you want to trade even in the secondary market, that is the account that you'll be using. So you can't change it midstream. So you have to pick an account. I usually tell people just open an account that doesn't have any ledger fees. So nowadays we have banks which do not charge ledger fees. So just open a new account, get the bank to sign and stamp for you. Two signatories of the bank also need to sign and stamp. And on your photo at the reverse side, they need to stamp and sign. Then when you fill it, you return it to CBK. It usually takes around 7 working days. They say 7, but at times it takes more. But around 7 working days, you'll get your account ready. You will get a virtual account number. And basically what this virtual account number means is that you have a bank account with central bank. So let's say you're paying for a bond, and we'll get to that. This is the account that you will use. It's mapped to your bank account that you filled on the mandate card. So this will take like 7 days, and you'll have your account. Another thing we need to remember is that when you open a CDS, it can only be free of holdings for up to 6 months. If you don't buy anything for 6 months and it's a new account, it will be deactivated. And to activate it, you will have to do this process afresh. So make sure that even if you open your account anytime soon, make sure before 6 months, that 6 month period lapses, you need to buy a security. You can buy the minimum for 50,000 so that your account is not deactivated. Before we go on, anybody who has a question on this?
Question.
Yeah.
Can I open the CDS account with my commercial bank as opposed to going to CBK?
Yes, you can. Yeah, the banks which do that. I believe Stanchart, KCB, but I think there are costs to it. It's I don't think it's free. And I usually say this, opening the account on your own, like you're the one who you're going to do every little aspect of it, investing, as in you'll follow up. It gives you a better idea, first of all, of how the market works. It gives you better control because at times giving instructions to a third party can cause issues. So to avoid that, just if you can do it, just open the account on your own behalf. And because there are times, I can give you an example. Let's say you've bought a paper in the primary auction or you're trading. You can imagine you have the bond that you want, and now you want to buy it or you want to sell it. Let's start with buying. So you have to give instructions to somebody at the bank to debit your account and now push the money to the seller. At times, and I've experienced this, somebody probably had too much to do that day or wasn't having a good day. They forget to do that instruction. they forget now to debit your account. When it comes to bonds, there's so much sensitivity when it comes to such issues of settlement and paying for bonds. It is very sensitive, and there are actually penalties to it. Let's say you're supposed to pay a bond, maybe our trading period is 3 days, and we'll also look into that, T+3. So if it's traded today, you have 3 days to pay for it. Imagine when it comes to 3 days and the instructions haven't been given, you'll actually pay a penalty for that. So I usually tell people, if you can, just do it on your own. It's not complicated. Having a third party in between is usually very, very difficult when it comes to giving instructions. Because remember, these treasury guys also are working on other different things. It's not only your instructions. And being human, somebody might delay, somebody might forget, and this will actually bring a problem later on when you want to deal with CBK. I hope I have answered that.
Yes. And is this process of opening a CDS account for bonds, is there an online platform to do all this? Because when you look at the equity side, when you're looking to open a CDS account for shares, there are some brokers that you can basically do everything through the online platform, either through web or mobile. So does the same exist for the CDS account for bonds?
Now, sadly, and I remember the time you hosted me, I talked about this. Sadly, no. And people have been trying to make this change, but our CBK is, I don't know, they're a bit rigid. So for local investors, if you're in the country, you have to visit the central bank, either Nyeri, Meru, I believe, Eldoret. You have to go there physically. Okay, somebody can pick the mandate card for you. That's not a problem. But returning it, you have to be there physically. Hopefully this will change in a few years' time. If you're out of the country, you can, there's a diaspora CDS opening account form. So you fill that, you scan it and send it, but you still have to send the physical forms through mail so that it reaches CBK. So the short answer to that, no, there's no online platform for it. Hopefully in a few years' time or in a few months' time, okay, let's say years, we'll have one. And to me, that is one of also the hardest things I usually deal with, because you can get a new client and they're like, okay, you take the mandate card to them, but now when it comes to opening the account, somebody is like, okay, I need to walk to CBK and drop this. They find it brings a bit of an issue. So no, there's no online platform for it up to now, sadly. Anything else? Bonnie, I've answered you.
Yes, well answered, well answered.
Okay, I think we can proceed.
Yeah,
so, yeah. So you have your account ready. Then what next? We look at how you can invest now in bonds today, because today specifically we're talking about bonds. So when it comes to bonds, we usually have an auction, and I'll describe what an auction is. So we say the government runs at a deficit, and let's say for this year, they want to borrow 600 billion from the domestic market. How do they approach this? So they usually maybe break it down, depending on the need now of the money. So maybe we're in January. Okay, let's talk about July. We're in July. How much do we need? Need maybe like 60 billion. So how do we go about borrowing the 60 billion? We'll do a bond. And how do they decide on the bond that they want? And I think I said I'll describe this. So there's usually something called the Market Leaders Forum. So different brokers are represented on that forum. You have a meeting and you actually decide on which bond that is supposed to be floated, but you won't know. You'll give your suggestions, but you won't know which one will be picked, because there's, I think, another committee that now decides will pick bond X, Y, Z out of the ones that they brought up. Because remember, currently we have like 67, 68 active bonds. So there has to be a decision if are we doing a new bond? A new bond meaning this is a totally new issue. So like if it's a 10-year bond and it's being issued in July, you will get that it's FXD, which is fixed, as in this is how it will be denoted. And it is the first 10-year being issued this year. So it will be FXD1, 2021, and then 10. The last 10 is the number of years. So if it's a new issue, that is how it will be denoted. If it's a reopen means that the bond was already existing in the market. And because it's existing, we don't have to issue a new one. Because remember, the government has to balance its payments also, its coupon payments. You don't want to have a scenario where all the coupon payments land in one quarter of a particular year and you're paying maybe like 30 billion in coupon payments just because you did not stagger the bonds that are supposed to be issued. So they decide that. They decide which bond. There's a question, Eric? They decide which bond will be issued. So it will either be a new bond, it will either be a reopen, or it will be an infrastructure bond. So I think those are the three different options that they can have. Because we've, the fourth one would have been an SDB, Savings and Development Bond, and we've only had one of that since 2011. We've never had, it was reopened once. We've never had another maybe 30-year issue or 40-year issue, because it was supposed to be a longer dated bond for savers, but we've never had it. So those are the three options: either a new bond, a reissue, or an infrastructure bond. So any question up to that before we go to the prospectus? If there is no question, yeah. So after they've decided, and we look at this month's prospectus, so they will now do the advertisement of the bond that will be issued, and the prospectus somewhere here. Oh, yes. Is it clear? Is it clear? You can see?
Yes, I think we can see it.
So this is the prospectus. So they've decided. So like for this month, there are going to be three different bonds. And like as I said, when we look at the right-hand side, so prospectus for two reopened 15-year and 25-year fixed coupon treasury bonds. And like I said, FXD1 It was the first 15-year, which is the last number, issued in 2012. So it was issued in 2012, and it was a 15-year bond. So basically, this is a reopen. It was a bond issued a while back. So if it was issued in 2012, how many years does it have to maturity? Anyone? How many years does it have to maturity?
3.
Class. Eric, Bonnie.
Is it 6 years?
Yeah, 6 years to maturity. So it was because it was issued in 2012. Then FXD1 2018-15 issued in 2018, 15-year bond, has around 12 years to maturity. And you see, the last one is what I was talking about, FXD1 2021-25. So this is the issue. So it was issued in 2021. Yeah. It's a 25-year bond, and it was issued this year. It was issued earlier this year. So on the left-hand side, you have the pricing. This is also important. Let's look at the first column for the 15-year. When you look at the part which is in bold, 1 second. The part which is in bold, 11%. 11% is the coupon, right? The coupon for that bond is 11%, but the clean price, which, and we also need to discuss this, the clean price is the price of the bond. Let me go back. Remember, bonds have, you're paid coupon every 6 months. So let's take an example. You paid coupon today. Okay, let's say on Monday. If you paid coupon on Monday, after that Monday, from Tuesday, Wednesday, going to the period that is near to the next 6 months, there's something that is called accrued interest. Basically meaning after you've been paid coupon, the paper now starts accruing interest afresh. That is supposed to be your interest. So from day 1 to the last day, which is just before the coupon payment, interest will be earned. So the clean price basically is price without accrued interest. Because, let me give you an example. Let's say I'm buying a bond from someone. This person has held, before the last coupon payment, the person has held the bond for 3 months. So there's another 3 months to the next interest payment. I need to pay this person for holding the bond for 3 months. You can't just wish off that period away. This person, for half the period before the next interest payment, the person held the bond. So you have to pay for that duration. So that is what is called accrued interest. So when you see clean price, it's clean price without accrued interest. And when it comes to the prospectus, the figures that will be there will always be clean price. This doesn't mean this is what you pay, 99.969 for every 100. You will have to pay accrued interest for it. And to see how much you pay, you just look at when was the last time that 112.25 paid interest. So you will see maybe paid interest in June. So you'll be able to calculate. And actually, when you look at the bottom part of it, there's an explanation, important information. the bond attracts the accrued interest of shillings 3.08 per shillings for every 100. So to get how much you'll pay for this bond on after this primary, you just add the 99.969 to the 3.808, right? But then now, remember, this is an auction, and we'll get to that also. This is an auction, but I was just trying to explain that the figures that are here are usually claim price. The bond will be priced without any accrued interest. And now accrued interest will be paid when after the auction has been done and you get to know how much you will pay. So before we proceed, maybe someone has a question on this, because this is a very important part of buying a paper in the primary market. So you actually need to understand this before you just don't buy for the sake of buying. You need to understand this part so that you're very clear, because there are times somebody just sees a bond is 11%. So to them, in their mind, they're like, okay, we'll pay 100 for 100. But then when the results come out, you get the person is being told to pay 105,000 or 106,000. And probably being a new client, they can't really understand why am I being told to pay 6,000 more for a bond that I wanted for a face value bond of 100,000. So this is the part of rates is actually very important to understand, because if you get this part, then everything else will be very clear going forward. So any question?
I think
A
Grace.
question.
Sorry. We can go Bonnie and then Grace. Is it Grace who wants to ask?
Yes, it's me, it's Grace.
Okay. Grace had some questions there, so I think she can go first.
Okay, thanks. I just wanted to find out, so when we have this prospectus, when we are going into the primary market, I think the investors are usually asked is it to bid for a price or to put a price there? So how do you what benchmark do you use to quote whatever price to make sure that your bid is successful?
Okay, it's great. We'll get.
Yeah.
Actually, we're going to that after this. So probably let's finish this part, and then now we'll go to the bidding, so that we have a clear picture of how to bid.
Okay.
Yes.
So the other question I had was on the difference between clean and dirty price, but you've explained it quite nicely through the accrued interest concept.
Okay.
Yeah. Thanks.
Okay.
Another quick question, George. No, for all this information on the prospectus, how does the CBK get it out? Is it on their website? Is it? I mean, how do you keep tabs with such releases?
Okay, for starters, yes, the information is usually on the website, but at times it can be late. Like this one, I think was 1 or 2 days late. So the best thing would be if you have like a broker, they should be giving you continuous information. Like this month, this is what the issue will be, and it's supposed to be on the papers also. I think the Sunday Nation just before the auction. So, and in between the week. So it's either in the paper, you need to be checking the website, because every month there's an auction. You will know in June there was an auction. We had an auction at the tap sale, and we'll discuss about the tap sale. In July now, we have this new one. So remember, every month there's an auction. Every single month of the year, there's an auction. So you also need to have that in mind. So you can be checking on the CBK website, and the auction is usually just before the month starts, or immediately after the month starts, and closing the first week, either the first or the second week of the month. So you need to know that July there'll be an auction, August there'll be an auction. But yes, it's usually on the website and in the papers, and you can follow if you're on Twitter or any other social media space. I think CBK has people who do it, but at times it's a bit late. But yeah, they usually advertise, and you can't miss it. Any other question?
Also follow us on Twitter. We always post this.
Yeah.
George also posts this a lot. So I mean, if you want to know any question, always ask. There should be always some information flowing.
You can't miss it totally.
Because it also doesn't happen like every day. So like when it happens, it's something big, and
it's something big. Yeah. Any other question before we now move to bidding?
So George,
yeah.
So the prospectus that you've shared, I'm guessing this is what we were referring to earlier as a tap sale, because these are previously issued bonds, right?
Sorry, this one.
Yeah, the prospectus that you've shared.
No, these are totally new ones.
Oh, but is now this the concept of a tap sale where CBK is issuing a fresh previously issued bonds?
No. Now, when it comes to a tap sale, like let's look at. Let me look for it. The one for June. Let me look for it quickly. That was the. You can see that. I don't know if you can see it. You can see it.
Yes, we can.
Yeah. So remember what had happened earlier. They had issued FXD 119.20 and FXD 112.20. But remember, I usually say that the governor is so strict on rates. He doesn't want very high rates. He doesn't want, you see, with high rates, technically it means the government pays more. So what did they do? They first issued 119.20 and 112.20 just to test the waters. And remember, they wanted, I think, 30 billion, and we can look for it, Raka, and they only got, I think, 9 billion. Let's just look for it. So what basically they do, they look for it. I should have had it. They just tested the waters. They realized that we are getting very expensive money from the market. Let's just reject. And after rejecting, they were able to get the rates that they were comfortable when it comes to paying. And with the new rates now, they issued a tap sale, and you have to abide by the new rates that they've issued. So basically, it's also, a tap sale is an instrument for government to check in aggressive bidders, people who want, because you get someone for like, is it 119.20? Somebody is bidding maybe at 14.50 and expecting to get, but you see that will be disadvantageous to the government. So let me just look for it 1 second. Results. Okay, we can look, even this one will work. You can see. It will reopen. Okay, just wait. Yeah. So this can work also. Are you able to see this? Are you able to see that?
Yes.
Yeah. So this was in May. Remember, it was a reopened 15-year and a new 25-year. So for the 15-year, for the two, they wanted 30 billion for the two. Total bids received for the 15-year, they got 11.5 billion, and the 25-year, they got 31 billion. So they got a total of 42.5 billion, which means it was oversubscribed for starters. But they only accepted 20 billion, meaning they got less. And in essence, it means people went in very aggressive. So you get someone maybe for the 25-year, you see the market weighted average is 14.06, meaning that is where most of the competitive bids were. But you get someone, you'll get probably the majority, or maybe at 14.1, 14.2. Sorry, you'll get there bids maybe at 14.2, 14.3, maybe even up to 14.5. You see, all of those will be rejected. And we'll also quickly look at that and how the pricing is done during the primary. But they got less money than they wanted. So what happens? Before May came to an end, this happened. Before May came to an end, they did a top sale for this. That's the top sale. But you see, what has happened? They've already gotten the figures for the weighted average, and now they can push people not to bid. Because you see, now when it comes to a top sale, you can't bid above this. You can't bid above 13.9 or 12.9. That is fixed at that. So you'll only apply at this and this, and pay accrued interest for the days that have gone by. So they use a top sale as a means of checking in on rates. If they do not want expensive money, they'll issue the bonds and see where people will bid. Then after a week, it's usually after a week, after they've rejected, first of all, so many of the bids, now they'll issue a top sale, but with fixed rates which you can apply for. That is totally different of when it comes to a new bond. So maybe before you go, any other question on that, on the top sale?
Yeah, just go back to that screen you are showing the top sale.
This one.
Yes. So
Yeah.
like here, this adjusted average price per 100, the 2019-15 is like at a discount.
It's at a
And
discount,
the
yes.
25 is, so why would one be at a discount and the other at is it premium? Is it the amount of time that has lapsed?
Yeah, that's a very good question. We'll need to look at when did 1915, let me show you, when did they pay, when did that bond pay its last coupon payments? Let's see, because you see, that's a factor. That's a factor as to why one is at a discount, first of all, and the other one is at a slight premium. So quickly, let me show you. So it was 1915.
Yeah.
1915. So to 1915, you see, it had just paid coupon on May the 10th, 2021.
I see. Okay.
So that is why it is at a discount. So it had just paid coupon and it was floated almost immediately. Yeah.
Okay, so it's really a factor of when the last how much accrued interest is applied.
Yes,
is applicable. Okay.
Very true. Yes, because I remember last year there's a reopen they did. I can't remember which paper, but the premium was so huge because the bond was, you'd buy it now and it will pay coupon in like 2 months' time. I think it was close to December. So they opened it around October. And like I said, this is a question you get every other day from clients. What am I paying more? The coupon, yes, is good, but I'm paying a premium on it. And that's why people really need to understand that concept of accrued interest and yield and all those factors. So it was like 2 months away from coupon, and it was reopened. So I think it was coming to around 106 for every 100. But you see, you're telling this person, yes, you'll pay a premium on it, but imagine in December, just before Christmas, you will get almost close to 3/4 of the money back as your first coupon payment. Yes. I hope
okay.
that is clear.
So right, so I just wanted to latch on that. So when you're looking at these tap sales or even on secondary market and you see a bond that's trading at a premium, you shouldn't really shy away from it and just look at it. It's like you're paying a price to get into the opportunity to earn that coupon rate, and you still get your money back. So it's not like you're losing money.
Exactly, yes. Perfect. That is probably the best explanation ever. Yes, don't look at the return. I usually tell people, look at what return am I getting in terms of coupon in terms of the real rate of return, in terms of percentage form. Don't look at, I'm paying a premium on it. Yeah, you're paying a premium, but you're earning your coupon maybe 2 months early or 3 months early. So that will negate the fact that you're paying a premium on it. So these are the variables that people should, like when it comes to investing, you should really try and understand. Because even with that premium, I think the paper was oversubscribed. I'll try and remember. And since I have your emails, I'll send it to you. Even despite the premium, because when you understand the concept of I'm paying this much because of XYZ, and even if I pay this much, I will still get my money back, and I will still, and you see, probably that paper has a coupon of around 13.9 or 13.8%. So you shouldn't let the high coupon go because you're paying a premium. This premium will be offset by the first coupon payment you made, and you'll still enjoy the higher coupon payments, maybe for 20 years or 25 years. So those are the factors that you really need to look at when you're bidding at the primary.
All right, thanks.
Yeah.
Thank you so much.
Any other question?
Just a quick question. Not sure if you'll tackle it as you continue. Now, let's say I want to introduce this subject of bonds to maybe a person who's really not keen on following up everyday market trends. Could you classify bonds as what I'd call a lazy investment, whereby you just buy it? For example, if you know it will mature in 6 years, you just buy it and forget about it. You just sit and wait for the coupon interest payments. Because what happens if what happens if you bought a bond and then it's reopened? I mean, must you be keen on what's going on, or you should be comfortable?
Now, when it comes to, remember, we'll still talk about investment strategies before we close. So yes, we are all different. It depends on what we want out of our money. There's someone who will be like, okay, I have maybe $1 million shillings. Let me just put it in one bond and forget about it. And I actually have a couple of clients who are like that. They put in money, they never bother to check them. They just wait for their coupon and earn their coupon, and life continues. This works out for probably older clients. Believe it's passive investment. You don't have to be active. You don't have to be checking rates or what is happening. That is allowed. You just want your coupon payments and you want life to move on. But remember, if you are a keen investor, you need also to take advantage of any situation. If there's a capital gain that has been made, why not take the money? And also on this, I have an example. I have a client who bought, I think it's in 2019, IFB. There was an IFB which had a coupon of 12.2. That IFB now is trading, and he bought at par. He bought it to the primary, and the coupon was 12.2. That is what he paid. I think now it's trading maybe at around 11.5. That's almost 70 basis points. When you look at the profit that person has made, it's massive. And you see, you explain it to this person, you can sell this bond, book in the capital gain that you made, and still get another bond, which has, like this year, we've actually had very good bonds with high rates. Get another bond that will give you a high rate. We've had, is it 2 IFBs this year? He would have actually gone into both at those high rates. But there's a rigidity to it, because you see, he's an elderly person. He just wants his coupon payments and wants to relax. So we all are different. But if you're keen on this, you can maybe take a position. If you add 1-2 coupon payments and then you realize yields have dropped. I got this paper at 13%. It's now trading at 12.5. And if I sell it at 12.5, I can still go back into the market and get another primary at 13%, or get a bond at the secondary market at 13%. So you can book the 2 coupon payments and a capital and capital gain on top. So at the end of the day, it really depends on what you want out of this. We are all different. We have different investment strategies. So it's for you to decide as a person, this is what I want, and this is what I will go after. I hope I've answered you.
Yes, thanks.
Yeah. Any other question? Okay, there's no other question. We haven't finished on the application, on the bids. So there's a primary we've seen this month. So let's finish the prospectus, then we go to the application. So basically, we've seen the rates, and then now we have the conditions. So the amount is 60 billion, and we have the 1/12/25. They tell you the number of years remaining for each and the coupon payments for each. Then there's the period of sale. You see, from the 28th of June to the 13th of July. Like I said, it's usually mid-month, by the way, most of them. And then value date. Value date is the date that is the date now when the pricing begins. So 19th. So the period of sale was between 28th to 13th. There'll be a period 13th. Let me see. 13th is on Tuesday. So after Tuesday, we'll have the auction probably on Wednesday or Thursday. The results will be out on Thursday. Then you have Friday and Monday to pay for it. By Monday too, you should have paid for it. So you see the value date is 19th. So basically that means that is when the bond now starts to be priced. The VD value date is when the pricing begins. Since you should have paid by 2, you need to pay by 2, and we'll also come back to that. So there's also a schedule for interest payments for all 3 of them. So if you ever buy a bond, you need to have this prospectus sent somewhere so you can follow up on interest payment dates. I remember seeing, is it last week or the other week, there's someone who was complaining that they haven't been paid their interest, which I'm sure, I was like, are you sure? Because that's a very big thing. So later on, they discovered that his bank was the one which had a problem. So you need to send the prospectus. And actually what I usually do is I have it on Excel. So I have it on Excel for different people. So you know that, and I'll tell you, like, maybe this Monday you're being paid your coupon. And the coupon is usually, most of them, all of them falls on a Monday. So by 10, they usually keep time. By 10, you will get a credit alert that there's money in your bank account. So you need to have it so that you don't realize maybe a week later that there was an issue and you didn't get your money. So we have taxation. We need to also to talk about it. We need to remember that bonds which are less than 10 years, as in the tenor of the maturity is 10 years and below, the withholding tax is 15% for such bonds. For bonds above 10 years, so we're talking about 10, 11, up to 30, the withholding tax is 10%, 15% and 10%. So shorter term bonds have a higher withholding tax, and longer term bonds have a lower withholding tax, which is 10%. And then now when you talk about infrastructure bonds, they do not have any tax element on it. So when you buy it, you will not be charged any tax. So here issuing
recording in progress.
Central Bank of Kenya, placing agents, banks, brokers. Now, after this, we'll talk briefly about the multi-price bid auction. I have a short explanation on it. But before we go to that, you need to realize that if you're investing more than 20 million, you need to be competitive, as in you need to put a bid. If you invest in less than 20 million, 100,000, 200,000, a million, 5 million, you can just apply at average. And if you do not want to miss, just apply at average. If you apply at average, you will get, that is 100% sure. You will never miss a primary auction at any given time. So the details of the bid closure. Nowadays, you can submit your bid using your phone. Things have changed. A while back, it had to be hard copy for retail investors, and for banks, they use the SWIFT system for them to place their bids. But now even for retail, you can just use your phone through Treasury Direct. And when you open your account, now you're given a form for Treasury Direct, so that your CDS account is linked to your phone, and you can apply, you can check your portfolio. There's so many things you can do using that Treasury Direct USSD. And then now the results, you'll be told about results, and then defaulters. This is what I was talking about. You see, defaulters may be suspended from subsequent investment in government securities. So if you don't pay your money by 2 on the last day, the Monday, before the period of sale ends, as in the period ends, you won't be able to participate in it unless you have a very, very good explanation to why you were late. They will just suspend you, so you won't be able to participate in subsequent primaries for a while. They are the ones who will decide for what period that you'll be suspended. And then there's a commission. So for any one of you who wants to buy bonds for someone, there's a small commission that you're paid by central bank, 0.15% of the face value. And then we need to talk about rediscounting. So what this means basically, sorry, let's say you buy a bond, but before I explain it, nowadays this doesn't happen. I don't believe it happens anymore. A few years back when you started, you could buy a bond and you're unable to sell it. So you can imagine you bought a 20-year bond and you held it for 5 years and you're like, okay, I need my money for a project. You go to the market, nobody wants it unless you sell it at a big discount, which obviously is a loss to you as compared to where you bought it. So what happens, you can write to the NSE, you actually write a letter to the NSE and request them to tell CBK that you want to rediscount your bond. So CBK will actually pay you, but they will pay you at 3% above prevailing market rates. So they will check where the bond is trading at in the market. So let's say it's trading at 13%. they will pay you at 16%. So you can imagine how much money you will lose if you rediscount. But at least nowadays the market has a bit of liquidity. I don't think people rediscount, but you see, it's you're supposed to use it as a last option, final option. So the issue of liquidity listing, the bond will be listed on the Nairobi Securities Exchange, and that's where it's traded. Benchmark bonds, we have specific benchmark bonds, as in that is where the index for the market, or let me put it easily. Let's say we have 5, 10, 15, and 20 as benchmark bonds. So any bond issued for 5 years, the rates and the structure of the bond should be similar to almost any other five-year issued, or a 10-year. So basically that is what benchmark means. Then it should mirror any other 5-year bond issued in the market. So eligibility, only investors with active CDS accounts can apply. So if you don't have a CDS, you can't. And then secondary trading in multiples of 50,000. So 50, you can buy 50, you can buy 100, you can buy 150, and it will start on Tuesday. So it usually starts the next day after the closure of the sale period. I think that's it. Any question on this? Maybe someone has a question before we go to the application. Any question? So basically, you can go to the CBK website and get this, and probably go through it because you see this is an active bond now and it's issued. So for you to better understand what happens, so you can go through this, go through the period of sale till when it stops. And now when you go to the auction, since we'll have your emails, we can email you the auction results, and we can probably go through it maybe on chat or something, so that you understand these 3 bonds were issued, what were the results, and how does that impact the market. So I guess we finished that part. Finished on that part. So this is the application form. I hope it's clear. Is it clear?
Yes,
Yes, it is.
Yeah. So like for example, you put the issue number FXD1 2019-20, the duration, so you'll write 20 years, value date you get from the prospectus, total face value in figures, you write it, face value in words, you also write. Now, this is an important part. If you want to bid, even for 50,000, you can bid if you want. There's interest, competitive rate. Here, you'll have to bid. But if you tick this box, you will get this bond at the weighted average market rate for accepted rates, and we'll look into that. So for small amounts, you just tick on average. But if you feel you're lucky, you can bid and see if you'll get or if you'll miss. And then your details now, local investor, your source of funds, telephone, CDS portfolio number, you write it here, and the virtual account number. This is just for treasury bills. If you want to roll over, so you give your authorization that if you bought a 91-day T-bill and you don't want to take your money, you will just roll over to the next issue, and they won't give you back your money. They'll put it back into the next issue. And then you just write your name and signature. This is for now, if you want a commission for placing agents. All brokers have, is it 26 brokers have codes. So I think for like Genghis is B12, if I'm not wrong. So they'll write their code here, B12, and they'll stamp and they'll take it to CBK. So basically that is the application form. I don't know if there's a question on the application form. Any question?
You need an agent to sign this.
No, you don't.
Okay.
Yes.
Oh, this is if they're doing it on your behalf.
Yeah, if they want a commission out of it, yes.
Okay.
You don't need, you can just fill it and take it to CBK. And that's why I was also saying, because of Treasury Direct, now the *866 hash, you don't even have to fill this form. From your phone, you can bid and you get to know if your bid was successful, and you will pay now from your bank. And I think before we proceed, okay, now you've done the application. Now you're told you're successful. So what happens? You know you need to pay for this. I don't have a sample. So basically what happens, you have to instruct your bank that I bought a treasury bond and I need to pay for it. And you know the payment, yeah, I think you can pay cash at CBK, but I'm sure it's only if it's a small amount, maybe 50 or 100,000 or maybe 200,000. But most of the time it has to be an RTGS. So remember, we don't want you to get suspended. You need to pay for this bond on time. So you, like the prospectus you've seen, you have to pay it by Monday after getting your results, Monday by 2. So you need when you know the details, because what happens, you usually get a report. They used to send it on email. Okay, they can send it on email if you request. It's called the bond bidders report. So they can send it on email if you want, but I think you can also get it on your phone. When that prompt comes, it will give you an application number. So maybe your application number will be 450. So when you're doing your RTGS to CBK, so the receiver, the Central Bank of Kenya, the account number is your virtual account number, this one. So when you open your CDS, you'll be given a virtual account number. This is the receiving account. Remember when you started, I said, when you open, you'll get a virtual account number. And basically that's your account number at CBK. So when you pay, the receiving account number is your virtual account number. That is what you put. And now you, on the narration, now you'll put FXD 1, 2019, 20, and the application number 450, just that. And now the bank will debit your account, and now we will credit your virtual account at CBK. And now CBK will just move, will realize, okay, we received money for maybe Grace, and now they'll move the bond to your portfolio. Now you look at your CDS, you'll see that you have your bond. So basically that is what happens during the application process. Any question before we move on? Yes, I think we can move on. This is practically clear. So this form is actually on the CBK website. So if you want to do it manually, the form is there. If you want to use your phone after opening the account, it's *866 hash, and you proceed and buy the bond. Now we look at, this is buying at the primary. Remember, the second bit of it was buying at the secondary market. So how we first of all need to understand how the secondary market works. You're not far from finishing. we need to understand how the secondary market works. So basically our market is an over-the-counter market. What that means, it's more of we negotiate. People negotiate on different bonds. The other day they were saying they want to have an electronic board like the one for shares. You see, for shares, there's a board. So maybe there is a Safaricom at 42.50 and your bid is at 42.50. So those two match. And then the match, you get your shares. Let's say you wanted 1,000 shares. For bonds, there's no electronic bond. So what happens in the morning? You get they're called flows. You get flows from different brokers. So a broker, let's say somebody used we can use any Dan Blair, Genghis, maybe we can use any. Let's say somebody bought a bond through them and they want to sell. So what happens? They approach the broker. They have 200,000 of the 30-year bond and they need to sell it. So you see, the broker doesn't have, unless they have someone in mind who can pick it, they'll have to show the market. So that is what is basically called the over-the-counter market. So everybody is shown this position. Okay, not everybody, but you'll get one position is like maybe half the market has that one position. So what happens after that? Let's say you're like, okay, this 30-year bond is attractive, 200,000, and maybe I'm getting it at a rate of maybe even 13.5%, which is above the implied yield where it's trading at. So you'll have to buy this bond. So you want to buy this bond, sorry. So what happens is you'll be sent the pricing, and this is what I mean by pricing. Let me show you. Let me show you. I have the pricing over here. Sorry. So you can see this. Yeah.
No, we cannot see your screen.
You can see it. Oh, sorry. Oh, I don't know how I'll get it, but just 1 second. Let me try and see if I can. 1 second, because this is important. Let me try and save it, then this is important. One second. Sorry about that. Okay, let me see if I can share it now. Okay. You still can't see?
Now I can see your screen.
You can see? Okay.
Yes.
Yes.
Yeah. So basically, you sent this. So this is a pricing for a bond that we were buying. So what happens is the rules dictate that if you buy in a bond, you should be sent this for every. It's in the, and I'll get it for you. It's in the NSE trading rules. So for anyone who's buying, you're supposed to be sent this. It will have the specifics of the bond, the bond itself, and then the yield to maturity. And you see, this is a yield that you agree before the pricing is sent. So when the pricing is sent, you agree that you buy this and at this rate. So what happens after this? You have to confirm that you're buying this. Every secondary trade, if it's a sell or buy, has to have a confirmation at the end. If you fail to confirm, then if there are issues later, you can't bring up those issues because you're required to confirm that either you're buying or you're selling. So the response to this, if you set the pricing, is yes, I confirm that I'm buying this, or I confirm that I'm selling this. If you fail to do that, the trade actually is not supposed to happen. So you've decided this is what you're buying, and this is the cost. So it was at a discount, big one by the way, and this was the face value. So what happens is, after this has been done, the seller will be called by CBK. If you're selling, if you have a bond and you're selling, you'll be called by CBK, and they'll confirm that you're selling. After you've confirmed that you're selling, CBK they will avail the bonds now to the trading book, which is at the NSE, which is now at the system, to show that these bonds are available, and they need to be booked, and settlement has to happen. So the buyer has to have funds ready to pay for this bond. So everything happens at the NSE. There's a explanation to it, which I've written, also I'll send to you by mail. But the short version of it is the CBK now will bring up the bonds for trading, and now from the NSE, the bonds will be matched. The CDS accounts for both parties, the buyer and the seller, will be matched, and something called an ATS ID will be generated. It's a system process, but basically, the buyer will get their money. The buyer will get their bonds, and the seller will get their money at the same time. Delivery versus payment. So it happens simultaneously. And remember, if you're buying, you see this has to trade, and that's how you get those bonds traded were like 5 billion today. This has to trade, but you see, after trading, it also has to settle. The payment has to be done. So after trading, let's say it trades on Monday, you have, so the trade date will be Monday. You have Tuesday, Wednesday, and the final day, which is Thursday, T+3, to pay for this bond. The other thing is, if you do not pay for this bond, you'll be penalized for it. You'll be penalized. Actually, you won't be penalized. The investment bank or stock brokerage will be penalized because they're the ones who brought up this trade and they didn't settle on time. So most of the time you're told before you trade, you have to fund your account. This is another area where I fight with clients because they're like, why should we fund the account and I'm not getting the bonds yet? But those are the rules that we have, so that if you fund funded your CDS account with your broker, they'll now be able to pay for this bond due before that period lapses. So there'll never be, how will I put it, an excuse as to why they did not do it. If they don't do it, it's their fault. If you funded the account and they do not do it, it's their fault, and they will deal with CBK. But it's, like I said, it's a very sensitive thing, and people need to realize that for you to have like good standing, you need to be very efficient when it comes to this. The settlement and payment of different bonds, you should never delay payments and such like things. So maybe someone has a question on the secondary trading. Any question? So we can move on. Okay. So maybe late, I don't know if we'll have time, but I'll send the details to you about secondary trading. So we look at different investment strategies. Before we go to that, any question? Because now you're moving to something different, totally different. So any question? Okay.
Sorry, a question.
Okay.
Based on your experience in the bonds market, is there like a minimum threshold amount that you would recommend to any investor? Like, you know, I mean, you can tell them the minimum is 50,000. Yes, that's the low. But is there like an amount that you would recommend and say that if you put in this amount, for sure you'll enjoy the returns? Because there was another forum, and we were with a guy who has dealt with bonds before, and he was recommending $1 million as the minimum. Yeah. So I don't know from your end, from your experience, what you would say.
Okay. What I usually say is, if you want to have the experience, for starters, I won't say that there's a recommended amount. I won't say $1 million. Maybe I'll disagree with that person, because you know, you need to understand how the market works. You've seen there's so many inputs, so many variables. So if you want to know right from primary auction and buying, especially buying and selling in the secondary market, if you want to master these two, I won't say that you need a specific amount of money. Just try with the bare minimum and see how it goes. So if it's 50,000, just try with that. If it's 100,000, try with that. Look for a bond in the secondary market. Go through the process of buying a bond in the secondary market. Hold that bond, maybe earn 1 or 2 coupons, sell it, understand that process. You see, you only become good after doing it a couple of times. On the other hand, if you just want someone to do it for you, you can get a broker to do it for you. So you'll have this amount and you'll be like, okay, so this is what I want to do. And you see, they don't have control of your account. You're the one who has control. But you will say, I'm looking for a specific bond, maybe a long-ended bond, which is maybe 100, 200,000. I need to buy it. You hold it for a while. You test the market. You put it out in the market for sell after it has dropped a few basis points in yield. So I won't say there's any recommended amount, but obviously when it comes to numbers, the larger the amount, the more that you make. But if you're looking at gaining experience and learning the ropes and seeing how the market works, you can start with any amount. You're not limited. You're not limited at all. And the good thing, I also talked about this when we had the first, when Mwango Capital invited me, when Eric invited me for the first talk, the market has really changed in terms of liquidity. Nowadays, you can even get bonds for 100,000, 200,000 readily available in the secondary market. Things have changed. Things have completely changed. And I'll show you the price list for the last, if you look at probably the best part of this year, retail trading, which basically is bonds less than, let's say 50 million, you'll get that space is very active as compared to the larger amounts, the 100 million. Okay, there are times there are big trades, but the retail space has also grown, which shows you there's a bit of growth in that also. Because you look at the price list, you get somebody traded 100,000, someone traded 200,000, there was like 50,000. So things have really changed. The market is a bit liquid nowadays. So if you just want to learn, you can begin with any amount. There's no problem.
Okay, thank you.
Any other questions? Okay, because of time, let's continue. So basically, this is what we were talking about. So we look at the strategy of, okay, we bought this bond. So we touched on this earlier, but now let's look at it. I bought this bond maybe at 13%, and yields have gone down. Can I take advantage? Can I book in my profit and probably buy another bond, and then can I keep on doing this? And as I say, this is very possible. So we'll need to, first of all, if you're doing this, you need first of all to understand the concept of the yield curve and how it affects bond yields. So basically, yield curve is a line that plots interest rates of bonds which have equal credit quality but different maturity dates. So like on this example, which we got from the NSE, you have all the bonds, 1 to 25, doesn't stretch to 30, but basically this is our yield curve, the most recent one. I think we got it on Monday. So when you come to 5-year bonds, you'll get, you see, it takes similar 5-year dated papers, and you plot the yields, the average yields where they've been trading at. So you'll get the 5-year paper, like here, it's trading at, I think that's around 11.2. You come to the 10-year, around 12.2 there also, like that. So you can get where each paper is trading. Let me show you something else. Over and above that, we have this. We have this. These are the implied yields. So, are you able to see that?
I'm still seeing the presentation, the bond investment.
You can.
Yeah, from the NSE there.
Okay, then. And now?
Yes, yes.
Yeah. So this is usually released every week, every end of week. So you get this. And now this has all the bonds, all the 60 something bonds and all the corporate bonds. So when you go back, looking, so it has the issue number, the issue date, the last coupon payment, the next coupon payment, maturity date, days to maturity, days remaining to maturity, the outstanding amount which was issued during the auction, and then the coupon rate, and now the implied yield to maturity. So basically the implied yield to maturity means for this 216.5, which just has 24 days to maturity, it should be trading at around 6.1982. But I don't think there's anyone who will buy that. It's just about to mature. So this gives you an indication where the different bonds are trading. This is like your barometer to know where the market is. So if you're really looking into trading, you need to be looking at this every end of the week, or you get it on Monday early morning. You need to look at this, so you'll have a better picture of how the rates have been behaving over the past week. Now we look at an example. You're past time, but you're just about to finish, I believe. Let me give you a practical example. There's yes, I'll give you the bond I was talking about. It was an IFB. I don't know if I have the calculator. I think I have it. IFB 25, this one. Let's look at that. Is it highlighted? You can see.
Yes.
Yes.
So remember I talked about someone who bought this and has made money but doesn't want to sell. So it's a 25-year infrastructure bond, and it was issued in 2019, right? For this paper was 12.2. 12.2, right? Its implied yield is 12 flat, right? So we need to look at this. Let me show you. Oops, I think I'll have to use another. Let me use another example. I can see the calculator for that. So back to this. Okay, back to this. Sorry about that. Okay, let's use this. I have a calculator for this. So this is IFB 2019-16. It was issued in, so it's a 16-year IFB. It was issued on the 28th of October 2019. The coupon rate is 11.75. and they apply this 11.6433. So is that visible?
Yes.
So let's say today is this goes. Okay. So let's say you bought this bond, let's say 100,000 shillings. So you bought this bond, you buy this bond on Monday. Monday is 5th. At
Sorry, George, the calculator has loaded because from mine I can only see a white screen.
you can say,
No, from mine it's blank. I don't know for the rest if it's okay.
No, it's just a blank screen, a white screen.
okay. Let me see.
Where is this calculator available from?
You have to make it, but
Oh.
what happens? Yeah, you have to make it. It's so what? Let's say you still can see it.
No, it's
Now
not.
it can.
Now you can.
Yes, yes.
Because of time, what usually happens if you want a calculator, you just ask your broker. They'll send you a calculator. I'll actually send it to all of you so you can play around with it and see how it works. So usually, and they talked about this a while back, because the market is small, so you get when there's a new issue, somebody makes the calculator and you request for it, somebody else sends you. But if you have time, you can actually make it. If you're good with Excel, you can make it, and you have time for that. So basically, let's say on Monday, you buy this IFB, that is 12%. So this is how much you'll pay. You will pay, remember, next interest payment is in October. And you will pay, after all the charges, you'll pay 101,695.68. Consideration, this is without the brokerage charges. You'll pay 100,684. Now when you look at accrued at that price, which includes accrued interest, you'll pay 100.6846. So let's say, and this is the amount of money the seller will get, and this is the amount of money the buyer will get. That's the difference. Let's say you hold this paper for, let's say, 2 months, which is 60 days. So trade date, you hold this paper till September. And instead of selling it at 12%, the price that you bought it at, you get someone who will buy it at 11, let's say 1160. Or 11, yeah, let's say 1160. So you see, when it comes to the amount of money you make, you will sell it at 104,000. You'll get 104,000 and you pay the 100,684. and you'll pay 106,000, and you'll receive 104,000 after brokerage commissions and that, and all that. So you see, when the yield drops from 12 to 1160, you make a profit out of it. So basically, that is what it means by trading the yield curve. But like we said, remember, different bonds have different maturity dates. For longer dated bonds, the change of this from 40 basis points. Maybe you can look at it quickly. Let's look at one second. Okay. Is that visible?
Yes.
Yes. So let's look at same face value, 100,000. So then yield, yes, you bought it at this. Let's say you bought it at 13.9, and then 2nd July. So you pay, if you buy, you pay 102,000, 056. And let's say you sold it at 30.0. You see, for a longer dated normal bond, the difference of just 40 basis points is bigger as compared to like any normal midterm. So for this, the difference is almost like 7,000 for the same duration and the same difference in basis points. So the difference is 40,000. So basically the concept of yield is that, of trading the yield curve, is that you can buy a bond, buy it at primary, maybe at that 13.9 or 2, pay the amount of money at primary and wait for it to drop and sell it at the secondary market and make you profit and get into the next primary, and also keep on doing that. It's actually very possible, and people do it. People trade for a living. But like somebody has rightly put it, the issue of the amount of money that is needed to do this. For sizable amounts, the bigger the amount, the more money that you make. The small amounts, you can be making this 7,000, 8,000. But the thing is, when it comes to bonds, the probability of you losing money is actually very slim, unless you sell that bond at a very big discount. But the idea that you can buy a bond and lose money as compared to equities, where you can buy a share and maybe lose half of your portfolio. If you put in 100,000, maybe 25% of the portfolio gets eroded, or 50%. For bonds, it's actually really, really hard, especially in our market. So the idea of you can be going into a bond, buying it and selling it, doing that, it's a very, very applicable. You can do it, and you can actually make quite a bit of money out of that. So there was a question on that. I know probably using the calculator, you have to use it a couple of times to understand how the difference in yields come into play. As in, if I buy this paper at 14%, sell it at 13.5%, you need to do it for maybe a bit of time for you to grasp that that there's this profit to be made, and there's also the issue of time. If 1 month goes by, I'm paying more. If 2 months go by, I'll pay more for that bond, etc, etc. So I'll get you the calculator, and now probably now from the yields that are in the market, you can be plugging in the yields for different bonds, because this calculator has basically all the bonds. It's been updated, so you can plug in and see the difference, especially with this new primary. So you can see how much you'll pay during the auction. Then maybe a week later, when you look at the price list and look at the first yields, as in the first traded figures, you input and see the difference, and see maybe in 1 week or 2 weeks time, this person bought in the primary and sold it in the secondary market, and they made this. So by playing around with the calculator, you'll actually have a knowledge of basically how the market works and how the changes in yield bring about a change in pricing. Any question on that? So I think we can continue. We're almost finishing.
How much longer do you have? I think we're a half hour past time, so maybe we can send the content to them, but unless they want to continue. I think it's lunchtime now.
We can just look at this, and then quickly we look at risk, or we can just look at risk.
We should leave them wanting for another session. Kidding.
No, let's look at risk quickly,
Okay.
maybe then we close. Yeah. So basically, yes, there are various risks that you can face when you buy your bond. So the first one is interest rate risk, and we've touched about this. You can buy a bond today, 12%. A few months down the line, the interest is at 12.5. When you look at the implied, you can only sell it at 12.5 or 13%. The perfect example is the last few weeks when you look at the treasury bills. We touched a high of, I believe, 9.24 for the 364. It's gone back to 7.84. So we went up, then went down. So you can imagine you bought a bond and you bought it at 12%, it's trading at 12.5%. If you sell it, you'll make a loss out of it. So when you look at currency risk, this is mostly for bonds that are not issued in the currency, in our currency. For example, the Euro bond now, you issue it outside the country, it's dollar denominated, and now we have to pay the coupon payments in dollars, and we have to pay the principal at the end of the period back in dollars. So you can imagine the impact that a change in the currency values in our country, what that brings. So every maybe $1 change, how much we'll be paying back. So in reinvestment risk, the risk that you bought a bond today, held it for 5 years, you had a high interest rate currently, but when it matures, you get that interest rates have dropped. So maybe you bought it at 12%, you get your maturity after 5 years, and you want to put that money back into the market. When you go back to the market, you get the same bond or even a longer bond, maybe trading at a lower value, maybe at 7%. You cannot get value for your money. Inflation risk, the value of goods has gone up. You put in money for a long period for a longer dated bond, but the inflation rate has been rising. So maybe you have a coupon of 12%, and when you invested, the inflation was at around 2-3%. Over the years, inflation gradually rises, goes up to around maybe 12% or 13%, meaning you probably not be getting value for the money that you invested. Also meaning that there might be a risk when it comes to selling that bond, that when you sell it, you also might not get a substantial amount of money to cover that period that inflation has gone up. Bond ratings, mostly for corporate bonds, you get a bond that was issued at when it had a good rating, and then rating agencies look at the company and it has been doing badly, and the bond rating drops. Its value actually just changes. Its yields go up, and you also don't get value for your money. Liquidity risk, I talked about this earlier, and this was a while back, and probably even now, once in a while, you can buy a bond, and depending on how the interest rate is, you might not be able to sell the bond for the figure that you want. You can, let's say, bought a bond at 12%, and a few months down the line, the rate goes up. Everybody goes for the more attractive bonds and leaving yours. They can't touch it because the rates are lower. So you end up losing. Because you cannot get value for the amount of money you invested. So basically, that's it. Whatever will be left, we'll send it on for those who have attended. It will cover every single aspect of what we have talked about. Okay, Eric.
Thank you. Do you have any questions for him? Quick ones. Don't see any. So I think you've covered it well. Thank you so much for the session. Let me end the recording.